Okay, I think we're all set to go. Are we set to go, Jerry?
We're good to go.
Okay, all right, good. All right. Hello, everybody. Welcome back to our monthly update on real estate monthly market update. And I'm here today with Terrence Terrell of Molitor Financial. Terrence is a past client. He owns a 3-flat over in the Logan Square neighborhood that he's done very well with. And he is, I don't know, Terrence, you won some kind of major award for bodybuilding, right?
Yes, I did. I am actually no longer reigning. This was 2018, but I was a 2018 natural world champion in bodybuilding.
Awesome. That's great. But anyway, he's now a mortgage broker with Molitor Financial, and I'll first go through our market update and share what's going on in the market, and then we'll ask Terrence to talk a little bit about the different kinds of mortgages, down payment requirements, and how your down payment affects your interest rate. So without further ado, and if you have any questions, by all means, put them in the chat box. Jerry is here with us this morning, and she's monitoring our questions and will let us know if there's any questions that we need to respond to. And if you're watching this afterwards, if you're not watching us live, then just go ahead and put questions in the chat box and we'll respond to them later. Anyway, so we're happy to answer questions. Let me see, I want to share my screen here and share with you what's going on in the market. So let me pull that up. Here we go, our weekly, this is a weekly market update that we get from our board once a week. They update it. They update it actually Monday afternoon. So it hasn't quite updated yet for today, but it's really interesting. It goes back 6 months, and I wonder if there's a way I can get this box out of the way here. Okay, let's see. Okay, there we go. So you'll notice that the green bars are 2019, and this is residential closed listings, and the powder blue is this year. And you'll notice that we are up substantially this fall from over 2019 in closed sales. The properties that have gone under contract, I mean, it's we're significantly up. Numbers of new contracts. This is new listings that are coming onto the market. And again, we're getting into our seasonal downturn. You know, this time of year, things normally start to ease up a little bit. But we are still over 2019 in terms of new listings coming on the market. These are the rentals. Rentals actually aren't doing quite as well as they did in 2019. And here are the open houses. How many open houses? These where you see the big dip. This is like Memorial Day. This is Labor Day. But this was when we were locked down, of course. And as soon as the economy opened up again, open houses came roaring back. And then this shows the activity in terms of showings. And what I find so interesting about this graphic is that the navy blue bar is 2019 and the 2020 and the gold bar is 2020. Obviously, when we locked down, showings, basically there weren't any, but we are up 18% in numbers of showings over last year. So there's a lot of activity going on in the market. Terrence, you can probably attest to this fact that you're probably really busy and doing all kinds of pre-approvals, I would imagine.
And also a lot of refinances. Yes,
Yeah, right.
definitely.
Yeah, sure. And here's the other graphic I find really fascinating too. The bar graph is the median sales price, whereas the line graph is the average sold price. And again, the powder blue is this year, the green is last year. But look how prices are up over 2019. I was looking at this a little earlier. A year ago, the median sales price was let's call it 230. We're now at 260. That's more than a 10% increase in our sales price. So I find that really stunning. And these are the rentals. The rentals are pretty much on par with what they were last year. The other chart that I like to show is this is what we call our info sparks, and this is for all of the Chicagoland area. And here again, median sales price. And this is for all different types of residential properties. Oh, wait a minute. No, it isn't. Here we go. All property classes. I was looking at condos earlier. So, but look again here in June, the median sales price was 250. It's been climbing. It's now up to 260. So even since June, our prices have gone up $10,000. And let's look at month supply of inventory. This is why the prices are gone up. There's no inventory. And right? I mean, there's just no inventory. And look at how many properties have gone under contract. I mean, it's just really been incredibly active. So that was kind of what I wanted to show you for the market update. If you have any questions about that, by all means, let us know. But Terrence, you want to take it over and share a little bit with us?
Yeah, so what I wanted to get into, and I won't spend way too much time on it, was wanted to talk about a couple of different types of mortgages, different down payment requirements, and then also, what that does to your interest rate and also monthly payment. So, the biggest, well, I'm not gonna say the biggest, but the main two different types of mortgages you're gonna have fixed rate, you're gonna have adjustable. I know that adjustable rate mortgages kind of get a little bit of a bad rap just because people hear scary stories about them. And I think that there are scary stories about them just because, pre-2009, people weren't required to educate you on what those are and what those mean. So fixed rate mortgages mean basically just what they sound like. Your interest rate will not change for the life of the loan. So whatever your term is, whether it's 15-year, 20, 25, or the typical 30-year loan. Adjustable rate mortgages mean that your interest rate is going to be fixed for an initial period, either 7 or 10 years. And then after that period of time, the interest rate will adjust depending on whatever the market is doing at the time. So it can either go up or they can go down. There are always caps on those adjustables. Generally, they are capped with how much they can go up every year and how much they can go up over the life. So generally, they can only adjust 2% up or down each year, and maximum of 5% up or down over the life of the loan. So you don't have to worry about your interest rate going from 3 to 35. That just won't happen. But the appeal of them, because I'm sure people are wondering, the appeal of them is that generally speaking, the fixed rate for that certain amount of time is going to be a little bit lower than it would be for a typical 30-year fixed. So that's why some people go ahead and go for the rate of the route of the adjustable. But I don't see a lot of first-time home buyers doing that. I mainly see people that are refinancing because they know they're probably only going to stay in the home for another handful of years and they want to take advantage of an even lower interest rate, or people that are buying for the second time. And they know, again, we're going to be in this house 5-6 years. So we'll do a 7-year adjustable, get as low of an interest rate as we can, because we know we're going to sell it at the end. Now, you don't have to sell at the end, but depending on what the market's doing, you might want to think about refinancing. But again, most first-time home buyers don't want to worry about that, so they go with a fixed. Now, with that being said, going back to just the fixed rate mortgages and different down payment requirements, people always ask me, what are the benefits of being a first-time home buyer? And really the only benefit there is that you get to take advantage of the lowest possible down payment if that's what you want to do. First-time home buyers are eligible to put as little as 3% down. Now, there are going to be advantages and disadvantages of putting, less or more down. The advantage of putting less down is obviously that you're going to keep yourself a little bit more cash liquid, so that you have something in a rainy day fund, so that you have funds to, maybe do a project or two around the house before you move in or right after you move in. One conversation I have with all my clients is that, look, I don't ever want you to liquidate everything you have to buy a house and then end up house poor. Makes no sense to do that. So, we want to kind of determine what is going to be the best down payment for you. Now, interest rates do fluctuate based on your down payment, and also something called mortgage insurance. So anytime you put down less than 20%, you're going to pay something called mortgage insurance on a monthly basis until you reach 20% equity in the property. So mortgage insurance is based on two things. It's based on your down payment and it's based on your credit score. So there's different tiers of mortgage insurance. So the higher your credit score, the lower that mortgage insurance is going to be. And also the more you put down, the lower it's going to be. And those tiers change from 3%, 5%, 10%, and then 15% down. The mortgage insurance tiers go down, the factor goes down every time you cross one of those thresholds. So also interest rates are going to be a little bit lower in those buckets as well. So 3%, 5%, 10%, and 15%, they're going to be a little bit lower the higher you go. Now, the interesting thing is they don't get lower at 20%. Sometimes they get a little bit higher, but then if you make it to 25%, they go way down. It's an interesting way that banks do this, but especially for things like condos, which they find a little bit more risky, they charge a premium for them. So the interest rates on condos are a little bit higher, but those adjustments go away once you get to 25% down. And I know I've just thrown a lot of information at you guys. So, obviously if anyone has questions, please feel free, to reach out and, we'd be happy to answer the question. But that's kind of a broad general overview of how down payments are required and how interest rates and mortgage insurance is affected based on how much you're putting down.
Interesting. That's interesting about what you said about the 25% down, all those premiums go away. I had a question there and it totally went out my brain. Sorry. I was kind of wondering about, 25% down. But so is there any, I know that with first-time home buyers, there are these first-time home buyer grants. And now it's been a while, but I've had first-time home buyers who have gotten into a property with as little as $1,000. So have you done much of that, or?
Yeah, so I'm going to give you a quick rundown on how those work. So those, well, first of all, one of the biggest misconceptions that people have is that there's something called free money. There's not. There is always fine print. Banks are out to make money. So obviously, they know that they're going to make money on you, interest, and they want to help you get into that home. So some of these first-time home buyer grants, if you will, first of all, they're what's called second liens on the home. So if a person, buys a home with one of them and they decide, in 3-4 years, this isn't the place for me, I want to sell it. In the fine print, when you bought that house, when you got that grant, there is a line that says you have to pay it back if you change the terms of financing within a certain amount of time. Generally, it's somewhere between 7 and 10 years. So what those do also is they come with a slightly higher interest rate. So the bank is willing to give you a credit or a grant in exchange for a slightly higher interest rate, because obviously your goal is to get into the home and they want to help you do that. But again, no one does anything for free. So their trade-off is we'll give you money, let's say it's a couple of $1,000s towards your closing costs, but in exchange, you're going to take a higher interest rate. And their rationale behind that is, well, we know we can give you a couple $1,000s now, but over the life of the loan, we're going to make more than that off of you in interest. So that's how those work. So sometimes it makes sense to do that. Sometimes it doesn't. It's, obviously on a case-by-case basis, some people are going to be a little bit tighter on cash to close, and that might be something that we'd want to look at, of getting some sort of lender credit. I always lean toward lender credits over grants because of the fact that lender credits don't have to be paid back. But the exchange is exactly the same. The bank says, if you take a higher interest rate, we'll credit you, a certain amount of money. This is basically the exact opposite of what's, what people kind of hear when they hear about, paying points or buying down the rate. It's the exact opposite. So, if someone wants to take a higher interest rate, the bank will give them a credit for it. They'll give them money for it as a way of basically just saying, thank you for taking a higher interest rate and paying us more money over the life of the loan. Also, conversely, some conversations that I have is that, the other way around, if some people want a lower interest rate and they want to buy that rate down, the bank says, okay, we'll give you a lower interest rate because we know we're going to make less money on you over the life of the loan. Because of that, we're going to charge you points. Points are percentages of the actual loan amount, but we're going to charge you for that. So it could be, a couple $1,000s to buy the rate down, just like it would be a couple $1,000s if you took a higher interest rate. It made sense.
Huh.
It makes sense in my head, but I do it every day. So
No, that makes a lot of sense. I never realized that there were such a thing as lender credits. I've heard of seller credits, which probably are the best solution for a buyer because it just comes, right off the purchase price. But yeah, lender credits. Interesting idea. In a competitive market, probably seller credits. I guess the downside of a seller credit is that the property would have to appraise out for that higher amount. That would be the only downside to that, really. But that might be the easiest way for a buyer to go, right? And seller credits.
Not necessarily easiest way, but it wouldn't affect the rate. So yes, obviously this is property specific, and I obviously always defer to you when it comes to this part, but it all depends on what the seller's net, or what the seller wants their net to be. So if the purchase price is, if it's listed for 200,000 and you want to get a $5,000 seller credit, if it's been on the market for a while, you get married, correct me if I'm wrong, but I'd say if it's been on the market for a while and there's no other offers and they just want to get rid of it, you can say, all right, I'll give you 200,000, but I want a $5,000 credit. Or, if it's, kind of like what you were saying, to your point, in this competitive market, you might have to offer them 205 and then ask for a $5,000 credit. So their net is still going to be 5,000, but you basically, it's a manipulation of the numbers. Right. So that's how you'd finance in some of those and get that $5,000 credit from the seller.
Right. Exactly right. So anyway, I don't see any questions. Do we have any questions, Jerry? I'm not seeing any in the chat box. But It doesn't look like it. Okay, good. Well, anyway, I hope that was helpful, and we will be back again next month, the fourth Monday of the month at noon. And Terrence and I will have, we'll do our market update, see what's going on in the real estate market, what's happening in prices. By next month, we will be in the holiday season. Thanksgiving, believe it or not, is around the corner. I actually saw snow this morning off my balcony here. Oh no, snow. But yeah, so it's winter is coming and the holidays are coming. So we'll see how that impacts our market. And Terrence and I will be back again.
Mary,
Terrence,
I lost your audio.
oh, uh-oh. Oh. I don't know. Anyway, Terrence and I will be back again next month. I guess we just have a really bad connection today. I don't know. It must be Zoom. I think it's Zoom is giving us problems today. But we will be back again next Monday, the fourth Monday of the month, with our next monthly market update. Have a good day, everybody, and we will see you then. Bye for now.